Welcome to the debate. When the government mandates a digital toll pass on your trucks, you essentially have two choices. You can slap a cheap transponder on the windshield just to avoid the fines and keep the fleet moving.
Right, the bare minimum.
Exactly, the bare minimum. Or you can use that new digital connection to upgrade your entire logistics network, tracking fuel optimization, route efficiency, fleet health, all in real time.
Yeah, treating it as an opportunity.
Precisely. And today we are looking at recent strategic frameworks, analyzing what experts are calling the global mandate storm. This is the massive wave of e-invoicing and digital reporting laws sweeping the globe right now. And the central question we're asking is, well, is this just a new toll booth? Or is it a catalyst to rebuild the truck?
And it's a really urgent question. I mean, from the European Union's VAT in the digital age, VITA, as it's known, to these incredibly stringent new rules across Latin America and Asia, multinational enterprises are scrambling.
Oh, absolutely scrambling.
Right. But today I will be arguing that treating these incoming regulatory mandates as, well, an excuse to completely overhaul your financial architecture is a massive, unnecessary risk. These are fundamentally just legal document transmission requirements. The source material outlines that it is significantly safer and operationally much more pragmatic to treat e-invoicing as a secure delivery task handled by dedicated message brokers.
And, well, my perspective is exactly the opposite. E-invoicing isn't just a government tax requirement. It is a gateway to digitizing your transactional truth. If you treat it merely as a compliance checkbox, you are leaving, frankly, the greatest financial opportunity of the decade on the table.
The greatest of the decade?
I really believe so. Unlocking that value requires a unified, technology-first cloud architecture. I mean, we are analyzing frameworks that show the legacy tax tech market is fundamentally broken. When global organizations try to solve these mandates today, they run into what the material calls the M&A patchwork.
Right, the mega vendors.
Yeah, these mega vendors who grew by aggressively acquiring local software companies, leaving you with these stitched-together, totally disparate platforms. So the enterprise falls into the pre-formatted trap.
Meaning the internal IT team takes the hit. It's Italy, France, or Malaysia, requires specific transactional data to be delivered securely in a highly specific digital format to their portal.
Sure.
That is it. That's the mandate. The strategic frameworks we're analyzing even admit that traditional EDI, electronic data interchange networks, are highly capable message brokers. They'd excel at taking a document from point A and securely delivering it to point B.
Yeah, they deliver it, but at what cost to the back office?
Well, think of them as a highly secure digital postman. If your primary objective is submitting an invoice to a tax authority without fail, avoiding penalties, and keeping your supply chain moving, leveraging that digital postman is highly efficient. What your perspective suggests is forcing an enterprise to merge global VAT logic, accounts payable automation, and AI sanction checks into a single platform.
Because it all comes from the same data.
But it's a massive overextension. It risks creating the very forced marriages of technology the material explicitly warns against. You simply do not need to overhaul your entire IT ecosystem to satisfy a tax mandate.
Okay. But relying on that digital postman is exactly what creates the IT nightmare in the first place. Let's talk about the ERP ecosystem. Your core financial software like SAP S/4HANA or Oracle.
Okay.
In the legacy model you're defending, satisfying these local mandates requires injecting custom code, separate tables, and localized configurations for every single country directly into your core ERP.
Mm-hmm.
So if you operate in 40 countries, you have 40 different customizations dragging down your system. It acts as pure technical debt, it makes the ERP incredibly sluggish, it drastically increases operational costs, and frankly, it makes routine system upgrades virtually impossible.
Wait, are you arguing that's a failure of the e-invoicing concept itself? Or is that just poor IT governance by the enterprise? Because keeping an ERP clean is standard operational practice.
It's a structural failure of the legacy vendor approach. They force you to pre-format the data, which means your ERP has to do the work. That is precisely why the clean core imperative is so vital. Instead of hard-coding tax logic into SAP, you send your raw, standard transactional data out to a cloud-native engine.
And this is the universal translator concept.
Yes, the canonical data model. For those unfamiliar, think of a canonical data model as a universal translator. Instead of teaching your core ERP system 50 different local formatting languages for 50 different tax authorities, you output your raw data in one standard canonical language.
Right.
The external cloud platform catches that data, translates it, validates it, and applies the local regulatory logic. Your core ERP remains completely pristine.
Well, in theory, yes. The universal translator sounds incredibly elegant. But, I mean, if you are an IT director listening to this right now, your alarm bells are probably ringing.
Why? It simplifies their lives.
Because you're thinking, you want me to take my raw, unformatted, highly sensitive transactional data, literally the lifeblood of my business, and send it outside my firewall to a third-party vendor to sort out?
Well, it standardizes the workflow. You achieve a map once, reuse globally framework. Let me give you a tangible scenario.
Sure.
Let's say you've spent months setting up your e-invoicing compliance for Italy. Next year, Poland rolls out their mandate. In the legacy service mindset world, you have to hire consultants to come back in, write new custom code for Poland, and mess with your ERP all over again.
Which is a known, manageable process.
But a slow and expensive one. In the canonical data model world, because your data is already mapped to that universal translator, you just switch on Poland in the cloud. The material notes this reduces subsequent implementation times by up to 80%.
An 80% reduction assumes nothing breaks in transit, right? And that brings me back to those alarm bells. Outsourcing the entirety of your formatting, validation, and regulatory logic to one single external cloud platform might simplify the mapping, but it centralizes the risk.
How so?
It creates a massive single point of failure outside the enterprise's immediate control.
Wait, calling it a single point of failure ignores the reality of how modern cloud architecture actually works. I mean, it's engineered for high availability, scale. It operates with redundancies that a localized custom-coded ERP module simply doesn't have.
But the risk isn't just server uptime, it's data control. Extracting and mapping data internally isn't a preformatted trap, it is standard, secure IT governance. The enterprise dictates the terms, shapes the data, and ensures its accuracy before it ever leaves the building.
But they're doing it for 40 different ways for 40 different countries.
Yes, but when you push all of that responsibility out to a unified engine, if that canonical data model encounters a global routing error or mistranslates a complex tax code across regions, your entire international billing operation halts. You are trading internal IT debt for existential operational dependency on a single vendor.
Okay, you're worried about the cloud platform failing, but you're ignoring the much more common reality, the failure rate of the data itself.
Data errors happen, sure.
Exactly. And let's look at what happens when the data is actually in flight, because this completely exposes the limitation of the message broker approach. When your secure digital postman delivers an invoice with a tiny error, say an invalid VAT number, what actually happens?
Well, the government portal rejects it, and the EDI provider passes back the technical error code.
Exactly. It passes back a cryptic raw XML error code, and it usually happens days later. Now, your finance team has no idea what that code means, so they have to open a ticket with IT.
Which is standard procedure for system errors.
But it's an agonizing manual loop. IT has to decipher the code, realize it's a data entry error, send it back to finance to fix the master data, and then restart the entire submission process. And this brings us to why embedded AI and real-time intelligence are mandatory, not optional.
Mandatory for a tax submission?
Yes. In a native unified platform, the technology intercepts the transaction before it ever reaches the government portal.
Intercepts it to do what exactly?
To perform real-time pre-submission validation. How does the AI actually do this? It doesn't just check if the file is formatted correctly. It dynamically cross-references the vendor ID in your invoice against live, continuously updated tax schemas and databases.
Right, checking the registries.
Yes, it checks the EU's VIES database, the VAT information exchange system, in milliseconds. If a supplier's VAT number was revoked yesterday, the AI catches it today. It even executes e-sanction checks against global watch lists to ensure you aren't accidentally transacting with restricted entities.
And blocks the transaction?
Dynamically. And the best part? It doesn't send a cryptic error code to IT. It flags the error to the finance user in plain language, who can resolve it directly via a conversational interface. You completely bypass the IT help desk.
I have to challenge this as a textbook case of mission creep. You are proving my point about massive overextension here.
How is saving the IT desk hundreds of hours mission creep?
Because does an invoicing compliance tool, a tool purchased to satisfy a local digital reporting law, genuinely need to perform unstructured PDF capture, accounts payable automation, and global blacklist checks?
Well, why wouldn't you want to? If the transactional data is already flowing through the system.
Because demanding deep financial intelligence and AP automation from a tax compliance tool conflates entirely different business processes. We are talking about a legal mandate to submit digital tax records. A digital postman does not need to open, read, analyze, and critique your mail to deliver it securely.
But if the mail is wrong, it gets sent back anyway.
Sure, but when you start bolting on ascension checks and conversational AI for the finance team, you are wildly over-engineering a tax mandate. The strategic material explicitly warns about this. Merging different architectures born in different eras with entirely different core purposes creates inherent operational friction.
But that friction only exists in the legacy market. That friction comes from legacy vendors attempting forced marriages, where they literally bolt a 20-year-old EDI message broker onto a separate, newly acquired tax engine after the fact.
Right, the patchwork we talked about?
Yes, that creates latency. But a natively built, unified platform doesn't have that friction because the AI, the tax engine, and the routing are all built on the exact same code base.
Okay, maybe the technological friction is solved, but the organizational friction remains. Think about a standard multinational. You have a compliance team focused strictly on tax risk and government audits. You have an AP team focused on vendor payments and cash flow. And you have an IT security team focused on global blacklists and sanctions. By trying to shove all these distinct functions into a single intelligent platform, you disrupt existing, highly functional silos.
They aren't highly functional, though.
Those teams are probably already utilizing specialized, best-in-class software for those specific tasks. You are asking a niche tax reporting tool to suddenly become the operational nervous system of the entire company. It's an unnecessary operational risk just to satisfy a local government's VAT requirement.
I get the hesitation. I really do. But I look at those silos and I see massive inefficiency. You're treating the nervous system of the company like a basic plumbing pipe. By connecting those functions, you are unlocking what we call record-to-report, or R2R optimization.
The holy grail of accounting?
Exactly. Let's walk through how R2R operates historically. The R2R process is the entire life cycle of financial data, from a transaction occurring to it being reported on the financial statements. Right now, because tax compliance, invoicing, and financial reconciliation live in the exact separate silos you just praised, the process is a nightmare.
It is complex, certainly. Financial consolidation always is.
It's beyond complex. It's archaic. Let's look at the mechanics of a month-end close. Finance teams have to extract data from the ERP, pull delivery reports from the logistics software, and grab tax data from the compliance system. They dump all of this into massive spreadsheets.
A lot of VLOOKUPs.
Thousands of them. Right now, you have highly paid finance executives acting as human calculators, spending 3 weeks a month hunting down a 12-cent VAT discrepancy on an Excel sheet, because the systems simply don't talk to each other.
And your argument is that an e-invoicing tool solves month-end reconciliation?
Absolutely. By establishing real-time transactional truth. Think about the power of having the absolute, undeniable financial truth, the exact millisecond the government approves that invoice.
Okay.
Because a unified platform holds the raw e-invoice data natively, it executes continuous auto-reconciliation. It doesn't wait for the end of the month. It cross-references issued invoices with internal ledgers and incoming payment data instantly.
And flags the errors.
Right then and there. It flags discrepancies in net amounts or VAT calculations. Executive stakeholders get real-time dashboards showing exact VAT distributions, total invoiced amounts, and processing risk indices across dozens of jurisdictions. You shift the finance team from manual data crunching to strategic business growth.
Look, that paints a beautiful picture of the future of finance. But I fundamentally reject using a tax mandate as a Trojan horse to force that kind of transformation.
A Trojan horse?
Yes, real-time executive dashboards and continuous auto-reconciliation sound wonderful in a boardroom pitch. But achieving them requires tearing down and rewiring how a Fortune 500 company operates at its core.
Not tearing down, evolving.
Trying to build a single global cockpit that handles local tax compliance, cross-border payments, and global VAT reclaim all at once is precisely how large-scale enterprise technology projects fail. They collapse under their own weight.
Only if you're trying to build it yourself using legacy parts.
Even with a modern vendor, you are taking a mandate, which again simply requires you to format and send a specific XML file to a government server, and turning it into a multi-year, multi-million-dollar digital transformation project.
But the ROI justifies it.
Fulfilling legal mandates through capable, secure message brokers is a highly pragmatic strategy. It does exactly what it needs to do. It protects the business from regulatory penalties, it ensures invoices clear, and it keeps the supply chain moving. And it does this without introducing the staggering complexity of redesigning your entire record-to-report process.
But if you remain document-centric, you are paying a massive opportunity cost. Without a technology-first approach, without that canonical data model acting as your universal translator, and without the clean core architecture protecting your ERP, you are essentially just buying a very expensive delivery service.
Sometimes you just need a delivery service.
But you are subjecting your enterprise to a cluttered ERP ecosystem, manual regulatory updates every time a country changes a rule, and a highly fragmented reactive view of your global tax liabilities. To bring it back to our starting thought, you're just throwing coins at the toll booth while completely ignoring the rich logistics data that could optimize your entire fleet.
And, well, my summary is that sometimes you really just need to pay the toll, keep the engine running, and keep driving securely down the highway. Viewing basic regulatory compliance as an excuse for an all-encompassing digital transformation introduces massive operational vulnerability.
It's a bold stance.
An intelligent enterprise has to know the difference between a legal transmission requirement and an internal IT overhaul. Now, we both certainly acknowledge that the legacy approach, custom coding your ERP with localized add-ons for every single new country mandate, is a flawed, unsustainable strategy. The technical debt is simply too high.
God, we agree on that.
We do, but we remain in thoughtful disagreement over the ideal solution. I believe a focused, decoupled architecture utilizing highly capable message brokers manages risk effectively, respects existing organizational silos, and keeps the business running smoothly.
And I maintain that adopting a unified, intelligent platform turns compliance from a burdensome cost center into a strategic growth engine. It is a fundamental question of how we choose to react to regulatory pressure, whether we view it merely as a rigid box to check or as the perfect catalyst to redesign and elevate our entire financial system.
There is clearly much more to explore in the source material regarding these global tax frameworks and the technologies evolving to meet them.
Absolutely.
The choice between building a comprehensive digital foundation or simply securing the transmission pipeline is one that every financial IT leader will have to navigate carefully, especially as this mandate storm continues to sweep the globe.
It really all comes down to what you are trying to build. A slightly better way to drop off the mail, or an entirely new way to understand and leverage what's inside it. Thank you for joining us for this conversation, and we leave you to weigh these perspectives and form your own conclusion.